Good morning, ladies and gentlemen. It gives me great pleasure to welcome you today to this annual general meeting, Combined Westfield Group. We will actually be holding 3 meetings today: the annual general meeting of Westfield Holdings Limited, and meetings of Westfield America Trust and Westfield Trust. Together, these entities make up the Westfield Group. Resolution 2 to 7 are resolutions of Westfield Holdings only. Those resolutions will be determined on a show of hands unless a clear majority is not able to be determined. In that case, I will move to a poll. Resolution 8 is a resolution for all 3 entities which comprise the group. The resolution will be conducted through a poll. The proxy results of each of these resolutions will be displayed immediately prior to the vote on each of them. I'd like to open the Westfield Holdings Limited Annual General Meeting, the Westfield America Trust meeting, and the Westfield Trust meeting. I've been informed that the quorum for each meeting is present, and I formally declare each of these meetings open. The notice of meeting, convening the meeting has been in your hands for some time. With your consent, I will take the notice as read. Do you approve? Thank you. As a procedural matter, when I open an item or resolution for questions, please raise your hand. Where possible, please make your way to one of the microphones located in the aisle. If you are not able to do that, we'll bring you a microphone. Please state your name before asking a question, and only holders of yellow and blue admission cards are entitled to speak. It is my pleasure to welcome the members of the Westfield Group Board attending today, including Lord Peter Goldsmith, who is based in London. He joins us for the first time via video conference from my New York office. Welcome, Peter. I think you can see him there. Unfortunately, for personal reasons, Mr. Roy Furman is not able to attend the meeting today. I would also like to welcome Mr. Dean Wills, who, as you know, retired from the board last year. It's good to have you, Dean, with us today. Ladies and gentlemen, we are obviously in the midst of very challenging times, the most challenging in the group's experience. Despite this, Westfield continues to exhibit the hallmarks that well served it a well over 49-year history. Over that time, we have built a company which is a leader in its market, not just in Australia, but globally. Whether times are good or tough as they are at present, our focus is on making decisions which position us for the long-term success. There's much hard work ahead and difficult times to work through, but at Westfield, we fully expect that we'll emerge from current economic conditions stronger than before. I say this because Westfield is a strong board, a proven executive team, and a business model that is founded on a strong balance sheet and sound operating performance. This company, ladies and gentlemen, is built to last. Our underlying business is proving resilient, and our geographic spread has meant that in 2008, when most companies failed to meet their financial forecast and cut distributions, we actually delivered the increase in operating segment earnings we forecast that early in the year. For the year, operating segment earnings were up 10.4% to $1.94 billion on the previous year, and we distributed 106.5 cents per security, the same as in 2007. That is a remarkable achievement when you consider that what was happening in the global economy throughout 2008. We could achieve that result for several reasons. Firstly, though we are living through an unprecedented economic downturn, we should remember that shopping centers are irreplaceable components of urban and suburban infrastructure. They have become part of the fabric of the society. Today, people use them more often and for more things than just shopping. And most of our shopping centers are of the highest quality. It means they are attractive to retailers and shoppers, and continue to perform well relative to lesser assets, even when times are tough. They outperform in good times and are resilient during downturns. Last year, Australian retail sales were solid, up 3.7%. New Zealand was down 1.2%, and the US specialty store sales were down 6.8%. In the UK, retail sales in London grew 3.8%, but fell 0.7% nationally. In summary, the solid performance of Australia has offset the challenging conditions in US, UK and New Zealand. These trends have continued for each market in the first quarter of this year, with some tentative signs of improvement in retail sales in the United Kingdom. The group's global portfolio is 96% leased, down from 97.1% in December, with an increase in store closure in both the US and UK during the quarter. While the global economic slowing last year there was still plenty of activity within the Westfield Group. During 2008, we successfully leased and completed 9 major developments at a cost of $5.6 billion. In October, we opened Westfield London in the UK and redeveloped Doncaster in Melbourne. Just as our centre at Bondi Junction set new standards for shopping centres when it opened several years ago, Westfield London has raised the bar yet again. It features retailers never before seen in a shopping centres anywhere in the world, and its design and facilities have drawn universal praise. Since it opened in October last year, Westfield London has traded well with solid customer traffic and retail sales. In the first 6 months of operation, there have been almost 12 million customer visits to the centre. That's 12 million visits to a centre that simply didn't exist 6 months earlier. More than 20 million customer visits are expected in the centre in this first year. We were told that this is not the time to open such a centre on the eve of a recession. My answer is that we build our centres for the long term, not for 1 or 2 years. We have opened plenty of centres in tough times. Parramatta and Miranda here in Sydney are just 2 examples, and both are now powerhouse shopping centres. There is no doubt that Westfield London will become a landmark retail destination for London and a beacon of the Westfield brand, not just in the UK, but globally. It was especially pleasing for me that the group was able to relaunch the new Doncaster, because that centre has a special place in my memory. It was one of the first centres we built in Melbourne, at the time in the middle of apple orchards and farms. Today, it has more than doubled in size and serves a high-income population with a variety of retailers and specialty food stores that are beyond anything we could have imagined back in the 1960s. Although we have historically and will continue to mark ourselves against our own objectives and standards, I'm pleased to say that the group's performance compared with its peers was also commendable. Since the start of 2008 until now, while the group's share market performance has been negative, we have outperformed the Australian listed property trust index by 19%, no small feat given that we account for 50% of that index. We also outperformed the global REIT index by nearly 3%. We have also outperformed most of our listed peers both in Australia and globally. You might be asking yourself at this point, how is it that with this strong performance and balance sheet, the group managed to record a fall in profit in 2008, the first in our 48-year history? The answer is that a few years ago, when Australia adopted new accounting standards, it required companies to attribute rises or falls in asset revaluation to the income statement. This meant, in years when valuations went up, the reported profit was abnormally high. Indeed, during these years, we very consciously focused and spoke about our operational earnings, in other words, our cash profits rather than the superficially more positive number produced by the new accounting standards. In 2007, for instance, assets were revalued upwards by $5.1 billion, and our new accounting profit for that year was $5.5 billion. But we chose not to promote that number. Instead, we focused on operational segment earnings of $1.8 billion. To us, that was the relevant figure and the true measure of our performance. This year, of course, it went the other way, and we saw a reduction in property values of $3.3 billion. Although our operational segment earnings were up 10.4%, the result prepared under the new system was a loss of $2.2 billion. In my view, this new accounting approach does not provide the investor with an accurate, relevant measure of our company's performance. The ups and downs of property revaluations from year to year have little short-term relevance to a group like ours because we don't treat our shopping centres as trading stock. The real profit we make and distribute to shareholders depends on how well we operate our centres, on what we earn in rent and other income, as well as providing service to our partners. That real profit has nothing to do with short-term movements up or down in the value of our property portfolio. Looking longer term as we do, despite the drop in values this year, since the merger in 2004, the group has achieved cumulative asset revaluation gains to 31 December 2008 of nearly $10 billion. So in recent times, you can see that our assets have grown in value far more than they have fallen in the short term in response to the global financial downturn. And when they start to recover that value in future, be assured that we'll still be talking to you much more about operating side of our business. Ladies and gentlemen, the speed and depth of the global recession has devastated global share markets. It has destroyed many companies, and the governments of the world are taking unprecedented action to minimize the losses and restore confidence. When share markets collapse on this scale, they do not discriminate. Solid companies with good prospects are punished, and the companies that are overburdened with debt or badly damaged. No company is immune from this downturn. Westfield is also not immune. But as I hope you can see from what I've said, we are different. We have always managed for the long term, looking ahead, anticipating events, and planning accordingly. This episode we are living through now is no exception. In the good times, we took steps to prepare for the bad times. We have no crystal ball, but it was clear to us some time ago that the days of cheap, easily available capital at unrealistic asset prices would not last forever. We began to reposition the company starting several years ago with the merger in 2004. We took steps to strengthen the balance sheet with a clear strategy to own the best shopping centres in the best markets. To that end, we sold 14 shopping centres outright, a move which was dilutive to our earnings at the time and which was queried by many in the market. We sold shopping centres when others were buying. The sale of those assets, along with joint ventures and issuing equity, raised $10.5 billion. And the balance sheet was further strengthened this year when we raised a further $3.2 billion. Over the past couple of years, we also had opportunities to buy many new centres, but we passed them up, believing they were too expensive. Management and the board maintained its financial discipline and retained our capital and avoided paying prices that were too high. Today, we can all be very glad that we took a disciplined approach. Sometimes it is not so much what you do, but what you don't do. The net result of this long-term planning is that we have relatively low debt, with gearing ratio of around 35% and over $7 billion of liquidity. All these things were achieved through careful planning and looking ahead. And right now, we are looking ahead again, planning and positioning the group for the recovery when it comes. Ladies and gentlemen, we are under no illusion about the tremendous challenge facing all companies, including Westfield right now. To navigate our way through this period of uncertainty will require all our resources. It will require an extraordinary effort by all of us. But the board, our executives, me, we are all committed to doing just that, and would like to thank the board and our executive team for their efforts in these difficult times. In fact, I'm delighted to welcome to the meeting today our entire senior management team, our managers from around the world who are meeting here in Sydney this week. We are currently taking a very conservative approach given the economic climate. The reality is that many of our retailers are under pressure. It's difficult to maintain high occupancy rate we have enjoyed historically in some of our shopping centres. The leasing environment is undoubtedly tough. We have therefore reviewed the timing of our redevelopment programme, and we are continually looking at ways to reduce the cost of our operations. We expect that our net operating income for the year ahead in the US and UK will decline. New Zealand is also expected to be a challenging market, while Australia currently shows signs of proving more resilient. We took all this into account when we made our forecast earlier this year, and our performance in the first quarter is consistent with these assumptions. Accordingly, I can reconfirm our February forecast that operational earnings and distribution will be in the range of 94 to 97 cents per security for 2009. That assumes no material worsening in global economic conditions. Despite holding back on the start of many projects, we are continuing with our pre-development work so that these will be ready to go when the time is right. We are also moving ahead with our two biggest developments at Stratford in London, adjacent to the Olympic site, and at Centrepoint here in Sydney CBD. I believe when they are ready for opening, they will catch the wave of the recovery and prosper. I've seen many times over the 49 years history. Shopping centres were built in downturn, but they were finished and leased up and ready to go when the cycle turned. In addition to these development projects, we should also remember that other opportunities should come our way in this downturn. Again, this has been the case in the past, and because we entered this downturn from a position of relative strength, we are well placed to take advantage of these opportunities if they make sense for us. We want to be in a position not just to survive, but thrive when the cycle turns. I ask for your support as we face this challenge, and thank you for continuing your faith in Westfield. I now turn to item 1, which is a discussion